Well, good morning. We're at 11:30, so we will begin today's session. Thank you for joining us. I hope everyone is staying warm and dry, no matter where you are in the country. And if you are heading off overseas somewhere warm and sunny soon, congratulations. It's so great to be able to get out there and actually be able to go overseas and use those passports if they haven't expired and get to see somewhere different. So thank you so much for joining us. This session will be recorded and sent out in a newsletter probably in the next day or so. So if you miss anything, finding it hard to hear or follow, you will be able to listen to it at your own convenience at some other stage when we send that out. And you can also send this on to anybody else that you think might be interested in hearing the information. Today we've got a full team on board. We have got our relationship managers, Simone, Vincent. Simone, do you want to say a quick hello?
Absolutely. Good morning, everyone, and welcome again to our Q&A.
Thank you, Simone. And also we've got Ross Latham is joining us too. Hello, Ross.
Hi, hello everybody. Good to see you. Glad you made the time to come and listen to what we've got to say. Hopefully it's of some use.
Awesome. And joining us today is our managing partner, Cam Harper. Thanks, Cam.
My pleasure, Heather. Good morning, everybody, and welcome along. And we'll give you as much information as we can over this next little period.
Fantastic. Last month's session was such a great success. We had some really great questions come through, and this session will cover off the questions that you have put through at the end after we've done a few little things that we're going to cover. If you do think of anything as we're going through the session that you would like us to cover, do pop into the little chat feature, which is at the bottom of the screen, and you can type in your question. If we get a chance to cover it at the end, we will do, but if we don't, be assured that we'll have a look at your question and we might just drop you an email or give you a quick call and have a chat about it. So hopefully we'll cover that. Just a reminder, this information that we're going to impart today is general in nature, and it's just about our peer-to-peer product. It's nothing to do with your own personal financial goals. We're doing a commentary on the market, but that's how we see it and how it affects us. So if you do want to get any specific financial advice, we do always recommend that you talk to a financial advisor about your own financial goals. So we'll get stuck into it. Now, some of you may have met or spoken to Simone, our relationship manager, along your way, and she's going to answer our first question, which is what we commonly get asked is, how does peer-to-peer differ from other investments that are available? So over to you, Simone.
Thank you so much. Thanks, Heather. We're jumping straight into it. And it is a question that we do get asked very frequently. What is peer-to-peer and how does it differ from other investments? Well, it's definitely, we've seen current investment opportunities definitely grown in the last 10 to 15 years. We've seen growth of a number of investment avenues. And this is, ways to try and grow your money either slowly or rapidly. And these, having various levels of risk and varying levels of complexity. So KiwiSaver being the most common, being a managed fund with some extra benefits and rules surrounding that. And in fact, 64% of all Kiwis out there and now have a KiwiSaver account of some sort. So for 1 in 4 Kiwis, that is the only investment that they have. So we may be familiar with some of the others that are out there, term deposits, held for a certain period of time, for a certain time frame, for a certain return, if it's not broken. Cryptocurrencies, such as Bitcoin, residential or commercial property investments, such as your rentals. Obviously, peer-to-peer sits in there as well. Their shares in stock, here or overseas, and government or corporate bonds, if you've purchased those, non-fungible tokens, a foreign currency exchange, they're all in there. The list goes on, but to really answer the question, we need to first look at what peer-to-peer lending is. And essentially it's the bringing together of people who essentially wish to loan money, either individually or perhaps collectively, to those who wish to borrow money. Now, this peer-to-peer lending model can look very different to some business or facilitator, depending on who is offering it. And it could look like small parcels of unsecured, small parcels provided against sort of an unsecured loan, or it could be larger parcels, and those could be provided against varying levels of security. Now, we're possibly, where Southern Cross Partners sits, we're possibly quite different to maybe an online description you may have seen to peer-to-peer because of our particular model. And for us in the peer-to-peer space, our target is short-term property lending. So that's where we sit. And by that, I'm meaning 1 to 2 years. We have a first mortgage over a security property, and we have a clear exit strategy provided by the borrower to us. So we set out these opportunities clearly on our portal, or on our investor portal for registered investors, with all of the relevant information and details provided. So we effectively operate as loan managers for that. And of course, in New Zealand, peer-to-peer is overseen by the Financial Markets Authority. So they ensure any facilitator or any business that is holding a peer-to-peer license follows those rules as set out in the Financial Market Conducts Act 2013. So it means strict markers that we need to meet, and we need to be seen to meeting those expectations every single time. So that's a quick snapshot of what it means to have peer-to-peer lending in our space.
Excellent. Thanks, Simone. Yeah, there's a lot of different ones out there, but we are very different. And I think it's really important to note that Financial Markets Authority, or FMA, are our governing bodies. So great point to pop in there. Most of you are existing investors, and you're familiar with the information we provide on our listings and about our properties as security. And one of the questions we get asked the most often is about the credit score. What is the credit score, and what does that mean? So that's a number between 1 and 5. With 1 being the best score, and best, 1 being the lowest score and 5 being the highest score. And it's an internal scoring system that our credit department use to ascertain the risk. So obviously we're looking at risk with our properties, and a credit score is one of those ways that we can indicate to you as an investor of where that risk sits. So we assess the properties and the deal overall, and some of the things all of the things that we'll look at for that will be the loan to value ratio, or LVR for short. What is that percentage? The loan amount, what is the total loan amount? Is it very high? Is it very low? What is the type of security that we've got and the location? Is it a standard residential property? Is it a commercial property? Is it a lifestyle property? Is it a bit of land? And what is the servicing ability of the borrower? How are they going to service or pay for this loan? So servicing is another phrase we use for how they're paying their monthly mortgage. We also look at, are we consolidating any other debts, any other business debts in with the loan? And also, what is their credit history like? So all of that information we pop into a formula, and it spits out a number between 1 and 5. And it really looks at, do we have the right people in the office, in the credit team, making the right decisions on whether we should lend in this area on the particular property? You know, a 1 or a 2 would be the lending manager, or the lending business development manager who are out there seeing our brokers. He or she could actually decide that's a good deal, we'll do that because it's a 1 or a 2. Anything more than that would be involved with a credit manager. Anything higher than, say, a 3 or a 4 would be probably managing partner Cam would get involved, and it could be up to a 5, could be board approval. And it really just makes sure that we've ascertained the risk on every aspect about that property. And have we got the right people with the right knowledge making the right decisions when we're assessing that loan? It's very clear that you understand it's not an indication of the credit worthiness of that person. So it's very different. We're not actually looking at do they have a good credit report? We're actually looking at the whole deal as a whole. Now, if they did have some credit issues, that would be listed also in our other information we have there. So we would definitely highlight that for you. So that is the credit score in a nutshell. If you do look at the little information icon, it does tell you all this on the screen as it is. But there's a little bit of information about the credit score. And of course, as we offer actual properties as security, we need to make sure that they're fully insured. What happens if something happens to that property? I'm going to ask Ross to take you through this aspect about the insurance. And also, Ross, could you make a comment perhaps on the rates? Who's responsible for the rates as well? So over to you, Ross.
Thanks, Heather. Yeah, insurance is very important. Absolutely, it's really important. So as you know, and as Simone had said, every loan we make is secured by a registered first mortgage over property. And from a security standpoint, it's very, very important that that property is fully insured. Before we fund a loan, our legal team will check to make sure that the property is fully insured. And then we're noted on the policy as an interested party, meaning that we have a financial interest in that property. Now, if the premium should go into arrears or the premium goes unpaid, it doesn't happen often, but if it did happen, the insurer would contact us to let us know. We'd then get in touch with the borrower to make sure that that premium is brought up to date. Usually by the time we get to them, they have paid it. In some cases, they will have gone to another insurer, in which case we would need a insurance certificate to give us confirmation that the property was still insured. Standard policy is that the borrower or ourselves would have 30 days to get that premium up to date. So we diarise before the 30 days is up to go back and check again that it is up to date. If it isn't, we would then pay the premium ourselves to make sure that the policy is kept up to date. And then we would work with the borrower. They would either repay us the amount or the amount would be added onto the loan amount and be paid up at the end of the loan. And similarly with the rates, we are listed on the title as an interested party. And if the rates were to go into arrears, the council would contact us as an interested party and we would work with the borrower to make sure that that gets brought up to date. So, but the insurance is the really important one, and we work very hard to make sure that the property is fully insured for the complete term of the loan.
It's fantastic, Ross. So if the rates were unpaid and they couldn't pay it, what would happen there?
Well, again, we would step in and pay them on their behalf.
Absolutely.
And then they would either repay us or the money would get added to their total loan amount. And when they settle their loan.
Yeah, absolutely. We add it to the loan amount. Yeah. So yeah, it's their responsibility to make sure it's paid, but we also have responsibility. So we make sure it's all covered. Great stuff.
Having those notes on the policy for the insurance and on the title means that we get contacted and can't fall through the cracks.
Absolutely. No, that's key. Fantastic. And talking to new investors, both, Ross, Simone and myself would say that the most important aspect about investments, aside from rate, obviously, is how are your funds secured? It's really important in this day and age that you need to know where your funds are, but also what's securing that. What have you got securing those particular funds? And this is done with a first mortgage. But how does that work? Simone, would you like to just take us through quickly how first mortgage works with our particular product?
Absolutely. Yep, absolutely. So great question. This question underpins the majority of what we do at Southern Cross Partners. So just a quick overview. The first mortgage is basically a charge that is registered against the security property that we have and takes priority over any other charge. And in New Zealand, we have the public register for land, and that is called the Land Information New Zealand. And once all of the checks have been done by our Southern Cross Partners lawyers, we've got a great team of people that work with us there, such as, just to name a few, a credit check, as Ross was saying before, a valuation check. perhaps even conversing with the borrower's solicitor. Should there be any charges, other charges on the property, our lawyers will converse with their solicitors, borrower's solicitors, and then we would go ahead and we would register our interest or our charge against that piece of real estate or property, and hold that in place until the actual loan repayment has been fully satisfied. So this ensures that we have the first bite of the cherry, so to speak, should we need to move into a mortgagee sale, looking basically at the worst case scenario. Now, if we did go to mortgagee sale and the borrower, the client, owed us, for example, 500,000, and we moved into a mortgagee sale and we got 800,000, we wouldn't keep that extra 300. The money from the sale of that security property would basically go back to the borrower or the client. We, them having cleared their debt, we would only take the debt that is owed to us in our contract. So that's basically how a first mortgage works there.
Fantastic. Thanks, Simone. And you say first mortgage charge means that we're first cab off the rank. And is there anyone that would come before us in any circumstances at all that might come through? And I might be dropping you in it a little bit, I'm sorry. So when it comes to like GST?
Right. Well, I mean, if there's GST in there, that has usually been removed at the time of what we've listed on our online portal. So that component would have already been calculated and removed. So we take the lowest possible loan to value ratio that we possibly could. So for us in-house here, it's sort of like a little bit of an iceberg. What you see on the top is not necessarily what you see on the bottom. Behind the scenes and under the water of the iceberg is all of these workings that go on. And, having the GST taken off these deals gives us a little bit more room to move, should there be GST that is removed once we went to mortgagee sale.
Absolutely. Yeah, that's a really important point, because the IRD, there's only things certain in this world are death and taxes. So basically the IRD would step in if there was any debt that needed to be paid or tax on that property, and that's why we do take that into consideration. And you may see the words excluding GST or goods and services tax on the valuation notes in any of the listings that you're looking at, and that's just as what Simone said, we have taken that already into consideration. So if the IRD had their hand out, if we came to a mortgagee sell that property, or if the borrowers are selling, it's already been allowed for. So we've made sure that LVR or loan to value ratio is the best possible. So fantastic. There's lots of little tricks in there. We had also some excellent questions that were sent through from investors and from you guys on there at the moment, and we're going to have a look at a couple of them now, or all of them. We can get through them all. The first one actually was really good, and I'm going to get Simone to take the first couple, one because it uses a four-letter word. And what's the four-letter word that we don't use in this business, Simone?
Quite commonly, people ask us how safe our investment is, how safe, and we consider that as being a four-letter word. But another four-letter word that I do like to use is risk. And I think that you need to look at, as I was saying before, with different investment opportunities, there are varying amounts of risk, and there are varying amounts of complexity to investments. And I think you need to look at, even though you're investing in a particular investment yourself as a peer-to-peer model, you're choosing the actual investment that you have read about, that have had all the details provided to you, and you choose which investment that you would like to invest in. So, in terms of not investing your money in us as a company, I think you do invest in us in terms of people that you trust. And for us as a company, we're not a small company, and we're not a huge conglomerate. So we have a team of people that really work as hard as they possibly can to mitigate the risks of any investment that we take on. So because we loan our own money first, you know, we want to know that before it goes on the portal to be sold to investors, we want to know that we've done everything we possibly can to move levers where we need to, and to mitigate as much risk as possible. But I couldn't say that that any investment that you wish to partake in would be safe. It would be an absolute disservice of any of us to say that anything is safe. There's varying levels of risk, and I think you just need to look at that case by case.
Absolutely. And I always say if anybody in any industry says, oh yes, this investment's 100% safe, I would run screaming from the building, because there's always an element of risk, and it's up to you to decide on where that sits for you. You talked to Simone about not investing in the company, but investing in the actual property, which leads me to the next question I'm going to get Ross to look at. Was a great question that came through about the chain of security that we have. What happens if something goes wrong with Southern Cross Partners and we all go to the Bahamas and you come to the office and the lights are off and no one's home? Ross, what would happen in that situation that would not happen? But would you like to make some comment on that for us?
Yeah, absolutely. And again, it's another important point. So as Simone and Heather both said, everything we do, every loan we make is secured by a registered first mortgage. And that mortgage is held by Loan Investment Trustees Limited, which is a trust company separate from Southern Cross Partners. The mortgage is held there, and anybody that invests in a particular loan will be noted on a register attached to that mortgage with a percentage of the loan that they hold. So in the very unlikely event that something was to happen to Southern Cross Partners, there's another company similar to us that's Financial Markets Authority approved. They would step in and continue to manage the loans on your behalf and manage your investment through to its maturity, to its conclusion. There might be a slight hiccup while they get on board with everything that's going on. You might have to wait a little while for a monthly payment, but they'll soon get that caught up, and then everything will just run smoothly. You'll just be dealing with a different company to Southern Cross Partners. Of course, at the end, at the conclusion of your investment, we wouldn't be here anymore, so you wouldn't be able to reinvest, but you'd have all your funds back and you would go on to invest wherever you wanted to. And you mentioned about running off to the Bahamas. Well, that just can't happen. Unlike some investment options where you pay your money into a company and the money is put into a pool and the company then invests your funds where they think they're going to get you the best return. That doesn't happen with Southern Cross Partners. When you invest in a loan that you've chosen. The money gets allocated to that mortgage and it's held in there. We don't actually hold your money. When the borrower repays your funds, it gets paid into that same trust account and then is returned to you, the investor. So we don't actually hold your funds anywhere at all. Can't happen. We just can't take your money and run.
Yep, that's a great answer there. You was exactly right. It's not sitting, in the back office in a vault that we can take off. It is on a particular property that can only be realised when that property is sold, and you have to go through the normal process with the mortgagee sale that would happen. The company that will come in simply replaces us as the loan manager. I don't believe there are any extra costs involved with that, simply because we already have a margin that is put into all of our loans that would cover any costs that any other loan manager that would step in would cover. So there was a question that's came up before from Kerry. Thank you, Kerry. I believe that would be covered, but don't think we're going to get to that stage, but that's why we do have administration fees for our loans that we charge our borrowers, and it's why we do have a margin that we take from between the loan rate and the investment rate. That actually brings me on to some of our rates of our renewed loans. So we have been renewing quite a few of our loans recently, particularly the construction ones that have been waiting for supplies, or in a lot of cases, it's not so much a supply issue, it's the council, getting council on board to actually come over and do the inspections. There's been a lot of our developments and construction waiting on the council. So we've had to renew our loans, generally for sometimes a 2 or 3 or 4 month period. And we will renew the loan if we believe that's the best strategy to get this loan repaid in full in a timely fashion. And as the loan managers, we will keep a very close eye on those. Sometimes we may increase the rate for the borrower. Other times we may not. It may depend on the loan term that they want to renew. It may depend on the circumstances of the actual loan. Is it a construction loan or a normal residential investment loan? And as you know, not all loans will repay on that date. If we do increase the loan rate for the borrower, we may be able to increase the loan rate, or the investor's rate for you. It is on a case-by-case basis, and not every increase will be an increase to you. As you know, we do work on a margin, and our margin is very clearly shown on our investment sheet. So you can look at the borrower's rate and you can look at the investment rate, and you can work out the margin in between. And that's what we take to run our business, to pay our staff, to keep the wheels going of what we do. And every business obviously is in business to make money, and we're not going to apologise for that. And it will vary though. Some of our margins are actually very small and some of them are quite a lot larger. So if you do see a margin, you do think, oh, that's quite a lot larger than what I've seen previously, is what I like to call swings and roundabouts. Some are smaller, some are larger, and they'll all come into an average. If you do have any specific concerns about that, please do give me a call personally and we can have a chat about that. There's a question that came about talking about defaults and mortgagee sales and what we had over COVID. It was a really great question. I just want to make sure everyone's aware that you can look on our website and look at our default rates. Default rates are updated at the beginning of every month. Our compliance manager goes through and updates those default rates. At the moment, we're 0 loans in default over 30 days. Which is fantastic. And you can see how we've been tracking with that on that particular graph. It's very, very low. Of course, over COVID, we had a lot of borrowers that found it a little bit harder to pay their mortgage. We didn't do any mortgagee sales over that time, but that's just not cricket really, is it? You know, if someone's going through hardship because of COVID, we don't want a mortgagee sell them. We do like to work with borrowers to try and find out what are their circumstances, what are they going to do to remedy. We did do quite a few hardship applications, and that meant that their loan payments were added to their loan until they managed to get back on their feet. A lot of businesses were affected by COVID, but we didn't do any mortgagee sales over that time. And you can obviously have a look on the website to see those default rates and how it tracks. Question we've got here as well is how many investors are on the platform? So we've got about 950 registered investors or registered investment entities. Some investors might have themselves a joint investment and a trust perhaps. And so we have about 800 to 850 active investors on our platform at various times. There's a question I can't really answer with any certainty, and it's about foreseeing investment interest rates by the end of the year. And Cam might be able to pop in and have a look at that on his portion later on. You know, who knows, we could get another COVID, I'm not going to mention monkeypox, inflation, another national disaster, a world disaster. You just don't know what's going to happen. But, you know, our conservative lending that we're doing and the type of borrowers that we have at the moment means that I believe that our rates will hold as they are. They may slightly creep up a little bit, but I think we like to stay in that medium bracket at the moment. We're not going to be seeing 10s and 11s and 12s, I don't believe, but I haven't really got my crystal ball at the moment. It's on the blink, but I don't foresee any huge increases in investment rate, maybe just a little bit. But I think if we're holding where we are, I think we offer for a really good product with a really good rate for the element of risk that's there. So I'm pretty happy about that. If they go up a bit higher, that'd be fantastic. Now, lastly, but certainly not least, I'm going to throw it over to our managing partner, Cam Harper, who's going to comment on the current property market, how we see it, also how development and construction are tracking, what we look for, and it may also cover off a couple of other questions that we had from investors that asked about particularly supply chain developers with shortages in materials and things like that. So Cam, I'm going to leave it to you to make a commentary on that, all of that.
Thank you, Heather. So the major thing for us, and firstly, just with Heather talking about interest rates, envisaging those, what they look like by the end of the year, I can safely say that I can't, whilst it's hard to predict what's going to happen in the future, we look at our rates all the time, consistently, absolutely, to understand our lending rates and our investment rates. It's a heck of a balance to understand, to make sure we got those within CUI. So that's a big thing for us to understand that. Now, a couple of things I'm going to talk about here are to do with what Heather was saying, and I'll probably start with the C word up front, which is construction. And the construction, for us, it's an interesting one. And before I get on to how we assess this, and I will say that this is all just what we are seeing in the market, okay? So if you want to do further investigation, I'd encourage you to do so. We have our newsletters that come out. We have Christina Leung, and she's on some of our webinars as well. She's Auckland Principal for New Zealand Institute of Economic Research, NZIER, and she has a lot of experience and is very, very good. Many of us also subscribe to Tony Alexander's emails, and I can say, without it being an ad for Tony, the premium version of those is not doesn't cost that much, and it's got some fantastic information. Another two main economists that I look at personally, and it's interesting to be able to get the right information in front of you. You need to understand, have you got the right information? And that's the same for us. Do we have the right information to make these informed decisions? So getting on to construction, we pulled out of construction lending about 6 months ago. There's still loans that are still going. Nearly half of our loans in construction, it's 47% of our loans, are due to mature in the next 3 months. Now, we still don't know how many of those are going to need to renew. We don't know that yet. We generally start that process a couple of months out, but our credit team have a large tracking spreadsheet that understands exactly where every single construction loan within Southern Cross, where they all are, where they're at in the process compared to where they thought they'd be at. And also, if you guys think back, if we all think back 12 months ago, Omicron wasn't a thing yet in New Zealand. I think we're still in the grips of the Delta scare, weren't we? And if you look back, we went into that lockdown, I'm going to say around August, towards the end of August. And guys on construction sites, and whether it be the people at Winstone Wallboards with Jib, they all got taken off site, and they couldn't work. None of these guys could work. So we had that long period where there was no construction. They got back on site relatively quickly compared to a lot of us who are office-based. But what that means is we've still got that delay is still coming through. Now, most of our loans, right, even back, if we go back to before Omicron, even right back to the start of COVID, which was, 2 years ago now, we started assessing our loans a lot harder. We're always very good in the way we assessed our loans, but we started being a lot harder in how we assess them. We went away as well at the end of last year from what's called, excuse me, I'm drawing on my hands, I need to get rid of that. We went away from capitalized lending. So what that means is the loan, interest of the loan gets put towards at the back of the loan. The person doesn't take on any repayments over that period of the loan, and they repay it all on the exit of that loan. Every single one of our loans that we currently have are all serviced. We check out serviceability of every single loan, and they're all being serviced, so we can understand exactly where they are, if they have any hardships, anything that's happening in that respect. So, checks and balances in assessing loans is rigorous, and it's same for the renewals. When they are renewed, they are assessed almost like a new loan. When I say almost, it's because we know what their repayment history looks like leading up to that. We do not renew loans that are bad loans. Just because they're renewed, it doesn't mean they're bad, like Heather was saying before. But we look at our loans regularly in construction. We look at them on the way in. We visit every single site to make sure that it's actually something for us. One of our directors or one of our senior management will go and visit with the borrower, visit with the builder, understand what they're trying to achieve, and then we'll visit them physically during the life of the loan and track them where they go on those as well. The other thing I'm just going to say too, and it's, you know, this is an unusual one, and I'd like to say ignore the media, but it's hard to, okay, because that is generally the source of information for many of us. We certainly have the radio going in our household, and you hear all sorts of stuff. But do your own research is what I'm saying. If you're confused, we did a survey a couple of years ago, and it was right across the country, a good demographic of people, as to what it is that they, how they got their investment advice. And by and large, most of it was, I don't get any advice, which was a concern to me personally. Secondly was the media. They were reading the newspapers, listening to radio stations. You know, there is such a thing called clickbait headlines, and I'll be as bullish to say that not everybody, I won't chuck all journos in the same boat, okay? But be careful where you get your research from, and I encourage you, do your own research. It's so, so important. I want to have a quick chat about valuations as well. You know, there are many ways that we will assess the value of a property, from a registered valuation. There's real estate appraisals, CMAs, which is a comparative market analysis, sales and purchase agreement. Our own experience, you know, I don't want to discount the 25 years this company has of lending and understanding how that all works. Like I was saying, site visits are almost all about potential loans, regardless of whether they're construction or an equity release or something else. We then look, as Simone was saying before, we look at the GST applicability. If there's any chance the borrower can claim GST, then we deduct that at the time. And after all that, we take the lowest valuation and assess the loan on that figure. And that kind of dials into a question here about a question that was, this one was, how does the current housing market affect our investments? Well, like the team have said, I think it's probably pretty much been answered, but we are a conservative company. We are very conservative. Our loan to value ratio is very, very conservative. But the thing I will say is there is always risk for everything. There is always risk. And, you know, as an investor, you need to understand that risk. The team is here to help explain those risks. There are plenty of outstanding financial advisors around who will help explain risks of any investment. But we do all we can in our power to mitigate these risks. But you do not know what's around the corner. You know, and whilst I touch wood to make sure, now to hope that the worst doesn't happen, we just don't know. Okay, so you just got to make sure you do your own research. That's super important. Last couple of things from me. It was actually, I'll go for another question here, which was someone asked, it's a very good question. We're hearing developers falling over with half the homes built due to shortage of material or inflation budgets, inflation budget blowouts. Should we be concerned in future? This is a concern. Absolutely, it's a concern. And I would think that there will be, unfortunately, and I hate to see it, we all hate to see it, businesses will fail. They fail every day, regardless of recessions or depressions or anything else in between. Businesses fail, you know, and sometimes it's done out of in matters which can't be helped. When I look at our loans, and I'm only going to comment on our loans, I'm not going to comment on anybody else's, you know, do your research, like I say. But we cherry pick our loans. We really do. Like I said, we've cherry picked more loans than ever before in the last couple of years. We have I was going to say a policy, but it's not a policy. It's more of a deal in the office. We assess a lot of our loans. We will take everything into consideration. We'll actually sit out in the office here and have a conversation, because there's a lot of experience at Southern Cross. And if anyone doesn't like a loan for any reason, then we won't do it. You know, sometimes we'll convince someone to say, well, have you thought about this? Have you thought about that? We have some pretty robust debates, generally over a cup of tea, but we'll have some pretty robust debates. We've been more conservative than ever when it comes to our lending, and from that lending, your investment opportunities. So yeah, it's probably something that needs to be seen. I'm just looking at my, yeah, but developers, just on that, with the developers falling over, you know, we do all we can through all our tracking to make sure that doesn't happen. We make sure our developers are all servicing their loans. With the new ones we've been bringing on, they've been having to service that for quite some time. And then we also look at how they, where are they at we have some very strong conversations with them. If we need to, Heather was talking before about Property Law Act notices, we can do that. But by and large, the main thing we always try and do is see a loan through to its conclusion. It's a lot less hassle and stress on all parties in that loan, whether it's you guys, it's us, it's a developer, it's a builder, whoever it is. But we are very close to all of those loans, so we will understand them. Last couple of things though, if you want to, I was going to talk about audits very quickly. We are audited. Our auditors and accountants are Baker Tilly Staples Rodway. They're just finishing an audit at the moment, actually, in the last couple of days of that. And it's financial audit. It's everything around our loan book. It's around our compliance. So it's a full audit of this business. And there's been no issues previously. They've been very, very happy, and we're looking good in this one. We have audits that go to the FMA, to the Financial Markets Authority. There is no issue from our side on anything. But if you want to know a bit more about us, as Heather was saying, give any of the team a call. Give me a call if you like. You probably get more sense out of these other guys, but give me a call anytime. I'm more than happy to have a conversation with anybody. But you can also, under the company's office, look us up on the company's office. And our financial statements are listed there. Look up Southern Cross Partners, look under documents, which is one of the tabs there, and you'll see that our financial statements are listed there. You can look through that, you can look through the auditor's notes, so you can look through anything you like. We've got nothing to hide, so I'd be concerned if we did. But Heather, that's about all from me, I think. But if anyone's got any questions, like Heather was saying, fire them through. If you think of one in the middle of the night, send us an email the next day, preferably, and we can go from there. But that's pretty much all it is from me.
Awesome, thanks, Cam. Just a little thing I thought about with the construction loans and making sure that builders have enough money. We often have a contingency that's incorporated into the amount that they've borrowed for the construction. Is that a set amount, or do we set it, or does the borrowers set it?
Often it's blended. We aim for, and it's very rare that we go outside of this, we aim for a 20% contingency. Okay, so whatever they've come to us, we'll put 20% on that. They often come to us to say, look, I've got X contingency, and we'll say, yep, okay, that's fine. We need to bump that up. They might come and say, I've got 10%. We'll say, look, we need you to be at 20%. And that's to deal with those, and it's good you brought that up. It's to deal with those inflationary budget blowouts or increases. I mean, many people would have seen that it wasn't that long ago. A lot of the building supply companies were only doing 7-day quotes. Such was the volatility in that market. 7-day quotes were all you'd be able to get. Trying to get a fixed price contract is hard work. It really is. So we make sure we mitigate that by having those lower LVRs. So our loan to value ratio on construction will not go above, or very rarely, generally will not go above 65% on the completed value of the house. GST obviously isn't on that. And then we have that contingency sitting in there as well as a part of that 65.
Great, that's great. Thanks, Cam. Yeah, I think it's important to investors realise that the amount of money that we hold back to do that construction, we've held about a bit extra just to make sure we've covered those overruns, and that's what that contingency does. And of course, when we're lending on developments, that's not just one house that's being constructed. It could be 3 or 4 or 5 or 6 houses, and when those are constructed, and the exit strategy 9 times out of 10 is to sell those properties and repay us, brings me into a question I just had come up about partial repayments. So some of our previous construction loans have been capitalised interest, as Cam said. The interest is capitalised into the total loan amount. And for you, the investor, that means your interest has been compounding. But during that loan term, if the exit strategy is to repay us by selling those properties don't necessarily sell all on one day. Their purchasers who are buying those properties could be settling on different days. So those properties or your loan may be partially repaid as the funds become available and they want to release one of those securities. They'll pay us the money. We have to distribute it to all the investors. So there's no tax reasons for that compounding investment being partially repaid. It was a question that Eve had explaining partial repayments on yearly compounded interest investments is this done for taxation reasons? So no, it's purely because that was the way the loan was serviced. And if they are paying our loan back through selling off the properties, they will be coming in at different days. If you don't like partial repayments happening on your loans, simply have a look at choosing perhaps a loan where that's less likely to have partial repayments, and that would be there's only one security, or look at the payment or the exit strategy. How are they going to pay us back? If you've got any questions about any of the loans that you're looking at, if that's a concern for you, hey, just give us a call. Give Ross a call, Simone a call, give us a call here in the office, and we can talk you through that particular one that you're looking at if partial repayments are of concern to you. Well, we hope you enjoyed today's session. If there's anything in here that you'd like to talk more about or more detail, please call us, email us. We're more than happy to go through in more detail. Drop us a line, and of course Cam's available to chat on the larger picture, of course. And for now, stay well, stay healthy, and please enjoy the rest of your day. And we look forward to seeing you on one of these sessions again in the future. Thanks so much.